Warm welcome to the next session of our Global Women's Financial Forum, Finding Alpha and Closing the Investment Gap. I'm Emma Crystal, Head of Northern and Western Europe and Sustainable Client Solutions Group in International Wealth Management at Credit Suisse. We bring you this panel at a critical juncture, when investors and individuals alike are considering how they can generate alpha and sustainable returns. While COVID has pushed US policy rates back to zero, we have been in negative rates in much of Europe and Japan for more than 5 years, and signals from policymakers indicate we may be in for very low to negative rates for many years to come. And where do economic fundamentals fit in with all of this? Just recently, many equity indices were at record highs, even as concerns of a second COVID-19 wave and its damaging effect on economic activity mounted. On top of that, as you will hear in a moment, these challenging conditions are often amplified for women investors, given behavioral aspects around investing. This session embodies the objective we had when we first launched the Women's Financial Forum. We wanted to feature great business and thought leaders on a range of critical topics who just so happened to be women. We're fortunate to have assembled 5 world-class investors to share their expertise and insights. Please note that you can find details on their backgrounds and accomplishments on our forum website. Our panelists are Sarah Chen, co-founder the $1 Billion Fund for Women; Johara Faradia, Executive Director and Chief Investment Officer, Illinois State Board of Investments; Catherine Casey Krieger, Chief Investment Officer, the Broad Foundations and Broad Family Office; and Sonia Loud, Chief Investment Officer at LGIM. And last but not least, I'm so pleased to hand over to my esteemed colleague, Nannette Hechler-Feder, who will moderate the discussion. Nannette serves as CS Global Head of Economics and Research and as the Chief Investment Officer for our International Wealth Management Division. She oversees all thematic research across the group, our super trends, which enable us to consider the ramifications and opportunities associated with many of the long-term trends we are discussing throughout the forum. Additionally, given this current environment, she and her team have been looking in depth at the topic of women investing, and she can share some of their key findings with us. Nannette, I look forward to hearing your market overview and an engaging discussion, and over to you.
Thank you, Emma. It's my pleasure to welcome all our panelists at this session. Just by way of introduction, I thought I could start the panel by sharing a couple of observations around how we foresee the outlook for investors over the next 12, 18 months, and draw out what is relevant about that outlook for women investors particularly, and explain why. So the COVID crisis really has precipitated one of the deepest recessions on a quarter-to-quarter basis in the second quarter of 2020. And while there are encouraging signs right now that there might be as sharp a rebound in the third quarter, in most countries it will probably not be sufficient to turn back the economy to full growth in 2020. And it will probably take as long as way into 2022 to get to the type of economy we had pre-COVID. And that is assuming a relatively optimistic outlook about vaccine and somehow coming to a more normal way of just living, let alone operating an economy. When we think about the labor market, it does mean that it will probably take quite a while before we also get back to the type of employment and really pre-COVID situation as far as unemployment is concerned as well. We are quite hopeful that the many disruptions that have taken place are not going to imply long-term unemployment that is higher than before the COVID crisis, but it may just take a long time, and perhaps the price to pay to get again towards an equilibrium on labor markets may well be lower wages, at least in economies that are quite flexible as the US are in terms of labor markets. So generally speaking, we think at Credit Suisse that the inflation regime we will all be operating in also as investors will be a moderate inflation regime. By moderate, historically, this means in developed markets, inflation between 0 and 4%, something like that. And that type of regime, we have extensive research to show that it's relatively positive for risk assets. And this will likely continue to be really the case, even as central banks keep monetary policy really very accommodative. I mean, the Federal Reserve has been interpreted as keeping its own interest rate policy unchanged at 0 until way into 2022, perhaps even 2023. And Emma was just saying in the introductory world, if you put yourself in our shoes here in Switzerland, where I'm speaking to you about, we have actually negative interest rates already for the last 5 years, and probably to be still in place for as much as the next 3 or even next 5 years. So for risk-averse investors, the outlook that we project is going to be one of very low yields for long. And many risk-averse, very conservative investors are really looking to grow their capital through the compounding effect of interest rates. And if there are no interest rates, there's nothing to compound with, frankly. And so unfortunately, when we take a look at how investor behavior is organizing among private investors, this may be particularly relevant and in some instances painful for women to grow their capital. There is sufficient research to suggest that the investment behavior of women is more conservative across all age categories than respectively the one of men. Certainly at Credit Suisse, we have found evidence for that very clearly. And interestingly, the risk aversion is really increasing in a particular age bracket between 30 to 45 years of age. This is where we are seeing that in the population of private clients at our bank, there is really this increase of risk aversion. This has an implication on the investment strategy that women also choose. It tends to be mapped with an investment behavior that is much more geared towards income generating strategies, such as bonds typically would represent in classical investment. And we have found that many women, even compared to the target investment strategy, asset allocation that they should pursue so as to achieve their objectives and be respectful of the type of risk tolerances they have, they are actually even more conservative than that. And they are, in the end, very heavily underinvested in risk assets, in equities in particular. So with that backdrop, the type of outlook we are now expecting for perhaps the next 18 months, perhaps longer than that, maybe one where especially this investor group, but more broadly, institutions that are looking towards conservative risk profiles have to rethink their investment strategy in order to achieve the objectives of their the plans that they are operating for their insureds, or if these are private investors for their own investment purposes. So with that as a backdrop, I would really like now to start in our conversation with each of you, and I'd love to start with you, Sarah. You are the co-founder of the $1 Billion Fund. And with that, you are really looking towards this consortium of global investors that you are reuniting and that have now not only pledged, but are actively deploying more than $1 billion in companies that are in particular led also by women. And I was just wondering if you could talk to us a little bit about your investor base, about the demographics and who they are, your investors.
First of all, thank you, Nannette, and to everyone at Credit Suisse for this opportunity. I think it's really a fundamental time for us to be speaking about this topic and also to be, frankly, removing a lot of the stereotypes which we tend to bulk women investors with, right? So just to give a little bit of context of our investor group, we're a global consortium of over 90 funds now that include sort of the GPs and LPs, so the general partners that are running the venture capital funds themselves, and also the limited partner investors, i.e. institutions, family offices, foundations, so on and so forth, that are investing into these venture capital funds. So we are working through the lens of venture capital, which can be seen to be a risky asset class, but one that has outperformed over the years, and I'm happy to go further into that. But our funds are 80% led by women, people of color. We're truly a global consortium, so we have majority of our base is in the US, but we do have a large contingent in Asia, where I originally come from Malaysia, and as well across Canada, Africa, Europe, and beyond. And what's interesting about these funds is even the institutions, despite what you hear about pension funds and so on and so forth being a little bit more conservative, some of the conversations I've had actually in the past couple of months have been certainly positive. Because venture capital, as you know, it's one of the asset classes that we need to continue to see to grow. How we're gathering today on this platform is through Zoom, which is a venture-backed technology. And with a lot of, as you talked about, Nannette, the backdrop of how the economics from a macro point of view is changing so drastically, frankly, we're seeing great investors that are looking to diversify, not just from a portfolio standpoint, but also, in terms of a behavioral standpoint. And I think this is something that you also see in your research in terms of who are these investors that are behaving differently, that are able to take on different risks. And I wouldn't say risk, I tend to like to avoid the term risk aversion, but rather that I'm seeing actually top investors, CIOs that are women, that are taking very smart risks, especially at this time when they're pressured for returns. So that's a little bit about us. And, we started in October 2018, really to rally the venture capital community to say, this is the time we need to continue to invest in women-founded companies. They are not, there's plenty of them, and it's not a deal flow issue. I like the quote that a colleague of ours in the industry, Cheryl Elston, speaks about, in that, if this money manager can go and find a deal in Latin America and in Asia, they can certainly find a deal that is venture-backed, that is led by a woman and founded by a woman, and we sincerely believe in that. So, we started October 2018 and achieved the goal of $1 billion in June 2019. So just under 9 months that we started this initiative to radically change the landscape, to say that capital is there and we're actively deploying it, and hence the name now Beyond the Billion, where our focus not only is in sort of ensuring that there's more capital, but to also work with the top of the capital stack. A lot of you here tuning in today, but the financial investors that are backing the funds as well. So that's a little bit of a start there for me, Nannette.
Thank you, Sarah. I mean, as we speak about the venture capital and this part of investments, what in your view are the success factors in that? When you look at the success stories in the $1 billion fund, what would you point towards?
Sure. So I like to look at the, what's powerful about our work in finance, and I love the way some of my colleagues sort of brand finance as an industry, in that it is a tool, an enabler for really economic empowerment and to create the change that we want to see, right? So whilst we can be caught in our jargon of the day-to-day of this and that, at the end of the day, the end goal is how are we powering the future that we want to see? and some of the success stories, frankly, in a time of COVID, I've seen the women founders do extraordinarily well. There are an example, one of the Canadian investments that one of our funds made was into Thornhill Medical, which is a producer of military-grade mobile ventilators. So essentially, you have a mobile ICU in a time of crisis where they've been basically granted a government contract to then supply this across Canada. And from an investor point of view, our partner funds, of course, are extremely thrilled by the returns that they're seeing because they're quintupling their returns. And I think what is key from a venture capital standpoint is, sure, from an investor point of view, it is patient capital. It might take a little bit more time depending on what stage you're investing in. But what's key about it is the entrepreneurial spirit that comes with venture capital in itself. One of my partners speaks about how founders, the nature of startup is such that you need to adapt so quickly. And in a time of black swan events such as this that we're going through right now, entrepreneurs are built to be able to pivot and to do the right thing, to then change strategy and do whatever is necessary to continue to succeed. And frankly, women founders and a lot of women around the table, as we know, are extremely resourceful. So whilst women tend to, and we talk about the gender venture investment gap, while women tend to raise about $1 million less compared to their male counterparts, they tend to deliver twice the returns. So, I mean, for me, this is just business sense. And at the end of the day, I'm hopeful that we're moving in a direction where this diversification is truly a return strategy and beyond the moral imperative, because we're seeing, as you talk about, all these critical success factors within venture capital, which enables us to succeed in a time of crisis.
That's great, Sarah. Just a last feeling of you. So you are certainly seeing the business side and women entrepreneurs that are being funded, in particular also through the channel of your fund. But do you feel that women are pursuing as investors different investment strategies as all? Do you have any perspective on that?
So, I like to decouple this a little bit in understanding why this is the case, right? With regards to how do we make the differentiation of women better, men better. I think at the end of the day, my personal belief is we must have diversity, and that's starting from gender, but it cuts across, right? Because when we look at a problem set, we look at it differently. I mean, you think about Facebook and the failures that they've had in the recent years in just identifying the problem set. It was because they had a lot of yes men, a lot of optimists. And, from the failure that they've experienced in recent years, they've then made an initiative to actually hire very different people with different backgrounds. And this includes, gender diversity. So from my point of view, it is number one, in the financial industry, we're seeing women outperform because, first of all, women and people of color only control 1.4% of all US financial assets. So to begin with, for you to be even in the game, you must be creme a la creme. So you've got to get top performers. I mean, some of our institutional investors shared with me recently that 40% of their top quartile money managers are women. And, frankly, I'm not surprised. And I'm sure a lot of the women around the room today are smiling because, we're the top of the class. We have to be to survive. That's number one. But number two, and I think Meredith Jones speaks about this a little bit more, but it's in the recognition that the patterns of behavior, just the way that we've been built and the way that we're wired as women, we look at problems differently, right? So when you talk about risk aversion, right, what I call smart risk, it is about evaluating with very little emotion. So even though women are seen to be emotional and hormonal in investments, and I'm sure a lot of my colleagues will attest to this, we look at a situation and sit with it a little while before we actually pressure ourselves to make that decision, which in a lot of cases, as I've seen in Wall Street, it's a hat tip to masculinity, right? So, are men performing more trades than women? Why is that? It's because they're pressured to do something right now. And especially in a time where it's so uncertain, I see women continuing to outperform because of the very nature that we've been built into, and that we're resourceful and we think deeply before we react. So those are my two thoughts there on the behavior between women and men. And I'm excited for what we continue to see, which is outperformance all the way. But
Well, this is I think it could not be a better segue into my conversation now with Johara, because you, Johara, are the CIO of the Illinois State Board of Investment. And one of the things that I read about you recently is that you have been number one for best private equity performance in the annual American Investment Council report. So I know that in particular you have been in the performances that you have been achieving, you have been devoting a lot of interest, emphasis on several strategies. Among those are ESG in particular, but then also especially emerging managers. And as we were talking about, well, what does make a good manager? The innovation, the resourcefulness, and how do you get actually to the top of class managers? These are topics that must be very close to your heart, and so I'd really love to hear why this has been so important for you in the approach you have taken at the board.
Absolutely. So thank you for having me here, Nannette, and I'm so proud to be on this panel with these other wonderful women leaders in our industry. So I'm excited to tell our story about the Illinois State Board of Investment. And as many of you already know, it really does start at the end of the day with the asset allocation. That is the main driver and what we spend most of our time on. But once you establish that asset allocation, we really do have a focus on wanting top tier, best in class asset managers. And so in order to do that, in my opinion, you have to be more inclusive. And so at ISB, we started, we established an appropriate infrastructure to ensure access to these top tier managers, including minority and women-owned firms. We have established policies, a specific investment policy, along with a diversity policy. We also have an emerging manager committee that truly holds us accountable. It holds me accountable as a leader of a diverse staff, as well as our board, who governs, who the emerging manager committee is a subset of our board. So I feel like not only do we have a policy in place, but I'm also held accountable to these efforts. And I've proven in all my years working at ISB, I started as one of the portfolio managers that sought diverse managers. So I understood the landscape, and now today, being the leader of ISB, I'm able to sort of set the tone from the top to ensure that our strategic partners and our staff are sourcing some of these top tier managers. So in terms of the overall portfolio, I think a lot of the times some of the questions people ask are around the fiduciary responsibility of, allocating to minority and women-owned firms. And I like to bring that up because typically it is asked. And for me, if you're asking that, at the end of the day, is your fiduciary responsibility is to cast a wider net and get access to the best names out there. So if your door is closed at the end of the day to providing an opportunity set to minority and women-owned firms, you're at a disadvantage. ISB's portfolio has about 39.1% of its assets allocated to minority and women-owned firms. Our performance as of the end of March 31st, 2020, we ranked in the top decile amongst our peers. The longer dated performance was in the 11th percentile, with one being the worst, one being the best and 100 being the worst. So for me, we're doing our job in being more inclusive. Performance has not sacrificed in doing that. So I think it's a win-win. And as Sarah mentioned, I think just being more, taking on calculated risk and truly understanding what risks you're taking to achieve your return. All of that is the main responsibilities of a CIO. So I value what it is that we built, and I'm really proud of it.
And just to come back on the asset allocation and just hearing about what the typical portfolio or the plans that you are managing are composed of, it would be really interesting to hear that. Also, because from a woman's perspective, if you think about it, we do have longevity. That is certainly another aspect in a very low interest rate world that has to drive the type of investment strategy that we are considering. So would you mind sharing a bit of details about what's the typical asset allocation that you are running?
Sure. So overall, our goal is to meet our assumed rate of return with taking appropriate risk, paying fees ultimately for value, but really at the end of the day, trying to control the fees and expenses of our plan. So it's very thoughtful. The asset allocation is a discussion we have on an annual basis. I'm always reviewing it on a quarterly basis. We try not to make significant changes to it and really take about a little bit of a 3 to 5 year runway before revisiting. Obviously, in light of the current environment, it's something we're watching closely. So ISB's portfolio, we're about 51% growth with a growth equity allocation. We have a allocation to credit, which includes multi-sector credit and private debt of about 15%. We're still working to get to that 15% in our private debt allocation, so we're slightly underweight at the moment. Rate sensitive, that's another differentiator, I think, and you may view this as being more conservative, but ISB's allocation is about 22%, which is slightly overweight relative to our peers. On average, we estimated about 19%. But, if you've read about ISB, we've eliminated hedge funds from our portfolio. We really, truly want to allocate to long-only managers with persistent alpha. And so for us to sort of get that downside protection, we overweighted long-term treasuries, which obviously worked out well for us in the first quarter of 2020. I like to take finance back to the basics. I don't believe in complexity for the sake of complexity. Treasuries are still uncorrelated, and I think there's room for them in the portfolio. Lastly, we have about a 12% allocation to real assets, of which 10% is real estate and about 2% in infrastructure. I know you mentioned us being number one in private equity. That is where we're slightly underweight, which is unfortunate to have stellar performance in an asset class, but we've been working to get to our target allocation of 7%. And something that we're revisiting is, again, with yields being so low and wanting to continue to, be able to capture as much of the upside as we can, do we increase our allocation to equity? Are there other risk mitigating strategies to consider? So these are the constant conversations I'm having with the team. But that's a general sort of overview of our asset allocation.
It's really interesting. I mean, you've just mentioned that you've eliminated hedge funds out of your strategies, and I'll be having the opportunity to speak to Casey in just a minute. But Johara, before I do so, is there, when you look forward now towards the next, what would we say, 1 to 2 years, what is the most important investment decision that you would point to? Is it to raise this allocation to risk assets, or what would be your key conclusion on that?
Yeah, no, absolutely. Is making sure we get the equity allocation right. I really believe it worked out beautifully in March of 2020. We were able to show the board that we were able to protect on the downside. I just want to continue to ensure that we're capturing as much as we can with an appropriate amount of risk on the upside. And that is what keeps me up at night.
Thank you. Casey, so you are the CIO of the Broad Family Office, and you have this very private investor perspective. You are also at the same time the CIO for the Broad Family Foundation. And you have done somehow an inverse journey by which you have started effectively managing practically a single stock portfolio, and have then gradually transitioned that into now a family office and foundation model that is really intended both to grow, but at the same time to give away also the majority of assets during your principal's lifetime. And in the course of that, you have set up an investment committee, bringing on board actually some of the leading hedge funds. What were what were the guiding views that you have followed by doing so, and can you talk a little bit more about your governance here as a private investor, to just contrast maybe with the more institutional investors we've heard so far?
Sure. Nannette, thanks for that introduction, and thanks for having me. This is such a wonderful group of people. I'm honored to be here. So as you mentioned, I manage the investments for the Broad Foundation, which is about a $2 billion tax-exempt pool. And in addition to that, oversee the investments for Eli Broad and the Broad family. Our governance structure by design is very streamlined. And I've been incredibly fortunate to have worked for the Broads for over 19 years now, starting at the inception of the family office, and almost 4 years ago, stepping into the CIO role. And it's been an incredible journey, as you said, starting primarily with an individual stock and working with the two prior CIOs to build out that portfolio into a diversified pool of assets with what we think are best-in-class managers. And as I said, the governance structure is streamlined. So Eli Broad is effectively the sole decision maker, and he is an incredible operator, he's an incredible philanthropist, and he's also an incredible investor. He follows the markets, he reads everything. So our conversations get right to the heart of the issue. I spend zero time having to really educate him or bring him up to speed on fund structures, on strategies, on risk. And that's enormously beneficial to our process. And then he understands he doesn't know everything, and he wants to bring in different points of view. So we put together this incredible investment committee, as you mentioned, folks with investment expertise, strong point of view, great network, and we lean on them to sort of check our thinking, to bring ideas, to suggest themes or managers. And it's a group of folks that are, by and large, based in Los Angeles. That was definitely important to us, to have folks that would come to meetings, would be accessible, would read emails, folks with investment expertise, with ideas. I mean, that's ultimately what Mr. Broad wants at the end of the day is ideas. And we don't have term limits. So there are pros and cons to that, but these are folks that have been working or have been a part of our committee, have been close to Mr. Broad for many, many years. Many of them worked for him at some point in their career. And that's been really beneficial too. There's a ton of mutual respect. And people are not afraid to argue, but it's always with respect. So that's allowed us to be opportunistic and tactical, flexible. We're not managing to a strict asset allocation target. We're willing to, significantly overweight and underweight certain asset classes. We're willing to buy individual stocks. We're active co-investors. We've even used derivatives to hedge currency exposure or equity exposure, or get long a theme or a basket that we think is compelling. And it makes my life pretty enriching and interesting as well.
This is just a side question, but how big is the investment committee? So just for this private investor, have you found that there is an ideal size of the investment committee?
Yeah, we currently have 7 people, and that feels about right. It could be one less, it could be one more, but somewhere in the 6 to 8 people has worked out really well. So that's been my experience.
Very interesting. In terms of the asset allocation and how you have been investing and how you have been adjusting, I mean, you've touched on some of the things that this investment committee has then proceeded to do, but how are you generally allocated by asset classes, so just to get a sense? And also, can you speak a little bit about how you have been approaching hedge funds? What has made you successful there?
Sure. So as I mentioned, we're not managing to a target. So our asset allocation has changed quite a bit over the years and continues to evolve. But over the last roughly 4 years, we've been pursuing what we call barbell asset allocation. And it coincidentally or fortunately positioned us quite well for COVID. Not that we foresaw a global pandemic, but rather than thinking strictly by asset classes, we really want to have safety net investments on one end, cash, we own some gold, we have some hedge fund investments that we think are diversifying and provide downside protection. So that's one end of the barbell. And then the other end of the barbell, we're really reaching for growth on the public side and the private side. We're leaning into US equities and China, and understanding that there's going to be a great deal of volatility in those asset classes, but in a low interest rate environment, we think that is where we need to be. We need to be with companies that can really generate attractive top line revenue growth and have high profit margins, low leverage, very resilient businesses. And where we've de-emphasized our time and our resources and our investments have been in places like low net hedge funds would be an example, where they're just sort of ball dampening, but still a decent amount of beta. We've had little exposure to financials, very little exposure to the energy complex, very little exposure to geographies outside of the US and China. So very little in Latin America, for instance, or Europe or Japan. And that had been working out well. And all of those trends that had been working were accelerated through the pandemic. So our discussion now is, are we comfortable continuing to lean into these sectors, these growth sectors, given that valuations have gotten pretty expensive? Do we want to trim? Do we want to take money off the table? And what we keep coming back to is, how much do we have in cash? How much do we have in safety net investments? Is that enough to meet all of our obligations? So any grant commitments, capital calls, expenses, for at least a 12-month period. And if that is the case, we do not need to play defense. And let's continue to stay invested. Let's let these things ride. We may hit another pocket where they're down 20, 30, 40%, but in 3 to 5 years, that we think the growth sectors is where we want to be.
So you as well, very much focusing on what is actually growing the capital base, of course, with appropriate risk management. But I am hearing this focus of what actually investors are left to do. There is nearly no alternative to having a forward-looking and hence equity-focused approach for the next few years, as it seems. If you were just giving lessons to a person or a private investor that is heavily underinvested equities at that point, so what would you highlight there?
Yeah, I mean, doing personal finances is certainly not my area of expertise, but I do get questions from other folks in our organization. We have a lot of young people that are working for the foundation and the family office earlier in their careers, trying to navigate these markets. There are friends and family of the Broads that I'm in touch with that are also trying to navigate portfolios that are much smaller than the Broads portfolio. And my advice is somewhat similar to how I think about the Broad Foundation and the Broad family pool of assets, in that figure out how much cash you need for the next 6 to 12 months. If your job goes away, if the worst thing, the worst of the worst happens, keeping in mind, do you have any large purchases coming up, things you want to set aside for? So whatever that amount is, keep that in cash, 6 to 12 months of living. And the rest of it, invested in an index fund, invested in a target retirement fund, and do not look at it. Just don't look at it. Put it in a drawer. Maybe check it once a year. But if your time horizon is more than like 3 to 5 years, you should be invested. And there was certainly a lot of nervousness in our office in March before we all went into lockdown around the markets, and should I be selling? Should I be trimming? And how bad is this? And I just kept coming back to that. Do you have enough cash to survive the next 6 months? And if you do, don't worry about it. leave it invested. Don't try to be too cute, too smart, and trying to time the top exactly and time the bottom exactly. You will never be successful in that endeavor. And for folks that are maybe now sitting here and saying, well, I've got all this cash and the market has run so much, and what do? I tend to say, just start averaging in. Don't wait for that moment when the market's down 40%. First of all, you may not get it. And second of all, when it's down that much, people are so scared. It's so hard to pull the trigger. So I tend to say, just, start every month, 10 or 20%, whatever that amount is that you want to ultimately have invested, just start buying. And some purchases are going to look really smart, and some may, trade down after you do it. But at the end of the day, you've just got to get invested.
Casey, thank you. I would now just want to turn to Sonia, because in Europe, actually, just to take a bit of a regional perspective and contrast that with the US. I mean, looking at institutional investors, the typical German pension funds, for example, are very, very heavily into fixed income, and actually only little into equities. And Sonia, you are the CIO of LGIM, so Legal and General Investment Management. So this is the 10th largest asset manager worldwide. It's the second largest in Europe. Do you see any regional differences in terms of how much investors, whether they're institutional or private, are willing to really step in and do what Casey just said, be in the market rather than trying to time the market?
That's a very good question, Nannette. And first and foremost, thank you so much for having me and inviting me to join this wonderful panel. And I'm happy to share a bit of the European experience of the COVID-19 pandemic. And I think, going back to how you introduced, obviously, the topic, Nannette, you've already highlighted some of the issues. And obviously, we know that the economic experience, the COVID experience, has not been evenly spread. And we have some countries that obviously have been hit a lot harder than others. And hence, I think identifying the challenge is very important before judging whether you want to step in or not. And I would like to link it as well to something, Nannette, that you have said in your introduction as well around the super themes and obviously the long-term thematic approach that I believe is incredibly important. Because if we learn something of the pandemic, is that we have, if anything, seen an acceleration in these. And understanding these, we believe, is fundamentally important for long-term investment success. But it's very clear, you've highlighted it, Nannette, Europeans, Germans in particular, they love their bonds. But let's not forget, for institutional investors, and LGIM is obviously the largest pension fund manager in the UK, bonds play a crucial role in the overall asset allocation context. So the challenge we get most of the time is obviously on how you deal with the situation we are facing. Because with one of the acceleration in trends, we know that obviously interest rates are rock bottom. Whether we are hitting a floor or not, I think depends on where you're based. I think for bonds, gilts, so most of the European bond markets, we probably can assume that we're very close to the floor. And hence the experience for European-based investors through the months of March and April has been very different to US investors. Because it's very clear that the 10-year Treasury was a far better hedge than the German 10-year bond. And I think from that angle, what we have been seeing is that that defines regional differences, but it defines as well how we then think about the current set of the opportunities. And the same true, obviously, for other topics around the change in the face of equity markets. Technology is now the largest sector globally. But again, it's been dominated by the US. So the experience for US equity investors has been very different to Europeans. And understanding on how the behavioral change and the fact that we're filming this panel today rather than being in it together, obviously gives you a hint on how important those changes will be and how we have to think about the investment opportunity arising from these are going to look like in the future.
And just to dig a little deeper, Sonia, so how are you responding to this likely persisting lack of yield? And if anything, I mean, our bond portfolios are going to perform really well if there's another shock. But let's assume that there is just the recovery that we are hopefully seeing also, especially if we are breaking through with a vaccine, then those bonds would probably represent a challenge as well. How are you tackling that with your investor base?
Yes. Nannette, that's an incredibly important question, and you will not be surprised to hear that's probably the most asked question these days from our clients, because it is very clear that the 60-40 balanced approach has been so popular for so long, and obviously has delivered stellar returns over the past 10 years. And so the question really is, can you still use government bonds to achieve the same diversification benefit and the same hedging effect that it used to provide during the past 10, 20 years? And again, the experience in the US has been very different in Europe, because clearly 10-year treasuries have provided exactly that hedge and exactly that diversification benefits, whereas obviously I think in Switzerland as well, the experience has been less positive, and likewise shared across a number of European countries. And unfortunately, and I think this was clear already from what all the other panelists have said, there's not an easy answer. There is no one fits all that would replace that exposure that government bonds usually provided. And as such, there will be alternatives to look at. And I think this was already clear from some of the asset allocation considerations we've heard, right? You need to find those asset classes that can provide this diversification benefit, that can provide still a positive contribution to the overall return, but most importantly, provide the hedging, so the risk reduction benefit that bonds usually provide. And it's fair to say there is still a few areas within the global government bond market that probably can provide some of those benefits. So 30-year treasuries, for example, or countries like Australia or South Korea, where you really go out in the long-dated bonds, probably provide you with some of those benefits. Foreign exchange will be part of the equation. We have to broaden just the allocation remit on what we're looking at. And here it really depends, obviously, what your starting currency is, right? Whether it's sterling, whether it's Swiss francs or euros, or likewise, obviously, from a US angle. So again, unfortunately, there's not a one fits all that I can now give out and say, oh, we should do this. And then we heard it before, it will be alternative asset classes as well that potentially can provide you with similar benefits. And we're looking at forestry, it will be venture capital, it will be those asset classes then that can provide a different profile that will help you with your overall asset allocation considerations. But it's clear that, particularly if I think about our core clientele of pension funds, that's a big journey. It's a big step from the classic allocation consideration to something that can accommodate the current environment. And I think, Nannette, you've already pointed to the biggest question, the elephant in the room. If you think about where bond yields are and you look at 10-year inflation expectation, you know the journey will have to change. And we agree with your assessment in the context, when will we close the output gap? So when will there be kind of real economy pressures potentially on pricing? Because then we know that the journey for bond investors can be even choppier than it has been. Because I guess until today, it's been quite a pleasant journey, but it's very clear that from here, I think we have to be far more agile in terms of our thinking around bond exposures. And this definitely includes the debate around inflation that surely will heat up quite significantly in the future.
And Sonia, so when you would point towards your key risks, what is keeping you awake at night, what would that be?
It is, I think, the understanding of these long-term trends. And to us, obviously, the big topics are not surprising, right? It is, policy making. It's ESG, climate change is a topic that has seen such a level of acceleration, and the way we can accommodate these. And obviously, we've talked so much about the impact of policy making. We haven't touched on the fiscal side yet, because obviously central banks have been so instrumental in the influence on markets. But if we think about the inflation topic in particular, it's very clear that we haven't really seen yet on how the fiscal stimulus is actually going to be deployed and how effective this will be, and hence supporting economic growth. But it's fascinating as well, because the way how these themes and thematic investing has helped to understand what's been going on until today, we believe that likewise, looking forward, this will remain probably the most important factor for investors to be successful. And hence, we would recommend really starting there in trying to understand, alongside all the other fabulous recommendations. But it's, to me, a real insight into investing and how to understand, how to be successful in investing your own money.
So as we come towards the end of this conversation, I mean, what has really struck me is the diversity in approaches towards taking the challenges. I mean, we have had here really two institutional investors, Johara, you on one side in the US and Sonia in Europe. We know, Johara, you're very focused on already from the asset allocation you described on growth, on particular risk asset classes, and are there trying to find the alpha with a very targeted strategy at identifying the best performing managers. On the other side, Sonia, you are in an environment where there is a lot of still of I would say tradition in institutional investor on bonds, and certainly the ride has been good, but you are preparing as well to follow what may be then a changing environment, and are looking absolutely to asset classes that are broader than that. You mentioned forestry, which was interesting to me, but of course venture capital in all its breadth. And then we had Casey here, which was highlighting a little bit outside of this classical, bond and equity, but still, how do I ensure that I have security, elements of security in the portfolio that give also a minimum of the required cash? And then on the other side, really the importance to take a very long-term perspective and invest in high conviction. I mean, you highlighted in the governance of bringing people that challenge each other and that are very well informed, that can point towards areas that are of particular interest. So very diverse way of setting out the quest for alpha. And so just question to the panel, has there been anything that the other panelists have talked about that has struck you, where you have made a note for yourself? Is there anything that you would like to point to before we close? Maybe if I can just ask just around.
I can start, Nannette. I think I've been very, I want to say pleasantly surprised for some, that have been bulked into the stereotype of what conservatism is in terms of investing. And I think what, if we were to wrap up with a call to action here, especially those who are tuning in from the institutions, large families, so on and so forth, you have a huge advantage in this time. I think it is fundamental that we encourage investors to take on smart risk. And I think alternative assets are definitely a rising star that we should pay attention to. I mean, the world is changing so rapidly, and your investments have the potential to make that change that we want to see in the world. From endowments, from pension funds, there's a lot of pressure, especially in the US with recent racial reckoning, which I think has been a good thing, where people are sort of, applying pressure and saying, hey, what are the investments that you're making that actually reflects the communities that you serve, right? And I think we need to ask this of ourselves, even as we're ticking the boxes, right, with what are the risk return profiles. I think it's important for us to question what are the patterns and beliefs and the structures that we're putting in place, things like a track record, right? If women and people of color have never been included in the system, they might not have the same track record that you expect, but how can you reevaluate this and speak to your boards, as I have seen even pension funds, do things, we talk about the work that we do, we invest across AI, blockchain, clean tech, fintech, you name it. and women are innovating across each sector. But it is about how do I ensure the continued capacity to invest. And I think as investors, we all have that power. And I urge you all strongly to think about that and to do more in realizing that, pattern matching, which is very popular in our industry, right, is important, can also be a mask for unconscious bias. And we need to take it upon ourselves to dismantle that and to change the landscape for, returns perspective and beyond, morality one as well.
Call for action, Johara?
So I definitely absolutely agree with everything Sarah just mentioned, but some of the takeaways that I actually jotted down during this was, wanting to pick Casey's brain a little bit on this barbell approach. It's something that we were thinking about internally, so it'd be great to have a resource to talk to who's actually implemented such approach. And of course, Sonia, it's great to kind of see what your perspective is and the expertise in Europe. So I'd love to be able to kind of follow up and talk to you guys. It's just great to leverage these resources and have other women with the same level of expertise, but sort of honing it in different ways. So to me, my biggest takeaway is I'm fortunate to be part of this, and now I have new friends in this space.
Great. Casey, Sonia, anything left for us?
Maybe just because I think what was clear as well, which I find very exciting, because obviously the industry has been, focusing on this debate of active versus passive. But I thought it was really great to see the active nature of that understanding, that research process, and hence the implementation. And I think with everything that we've discussed during this panel, it's very clear that the opportunity set needs to be identified. And this is an active process of understanding where the opportunities are, which I find is remarkable and obviously really exciting given the huge trend we have seen towards passive. But with all the difficulties, Nannette, that you've highlighted in the beginning, we've touched on inflation and the potential acceleration of change. I think there's a real opportunity again to see the active, the active passion come back and the active discipline come back a bit more.
Well, in that case, I mean, it's been really a pleasure to speak to you about the areas and your approaches to that. Thank you to all of you for having joined us here, and I hope our audience has had as interesting things to take away as I have. For me, the most important call for action is in particular for private investors and for this one part of private investors that are women, that they really consider having exposure to assets that they consider being invested. I think for me, the most important lesson is that the point about it is so much more important to being in the market rather than trying to time the market. And Casey's advice here to even not really think too much about it and not look too often about it is probably for a long-term investor the best way to go about. Of course, understanding that it has to be done in a well-managed risks, and as well to be open to learn about investing, to really feel comfortable with it. I mean, you as yourself, professional investors, have highlighted some of the different ways to get comfortable with investing, and this is something that I feel is the most wonderful thing that you have shown here. So thank you very much for this great panel, and I hope to stay in touch with you as well, and hopefully our audience has taken good takeaways. Stay safe.